Welcome to Financial Repression Authority's Roundtable Insight, where the best fund managers, economists, and industry leaders discuss the key investment issues and challenges in the current macroeconomic environment.
Thank you for joining us. I'm Gord Long. I have Dr. Lacy Hunt from Hossington Investment Management joining us today. Lacy is well-recognized authority in banking, debt securities, and particularly the U.S. Treasury market. Welcome back, Lacy.
Thank you, Gordon. Nice to be with you.
Lacy, maybe we can begin for the benefit of our many first-time viewers with a brief outline of what Hossington does, your role, and background. They may not be familiar.
Well, Hossington Investment Management manages about $4 billion of institutional fixed income money. We're duration managers. This year happens to be the 50th anniversary of the defense of my doctoral dissertation. So I've been in the game a long time. After my doctorate was complete, I went into the Federal Reserve. William McChesney Martin was chairman. A lot of people don't remember his name. Great Federal Reserve chairman. When I left the Federal Reserve, Arthur Burns was chairman. Both Burns and Martin were fighting the Vietnam War inflation and other problems as well. From the Federal Reserve, I went to Chase Econometrics, which was a subsidiary of Chase Manhattan. I was actively involved in building both small and large-scale econometric models, and I had the opportunity to do some work for the great David Rockefeller, who was chairman of Chase Manhattan in those days. And from there, I went to what would become the largest bank in Philadelphia, and then I spent about 15 years in the HSBC organization. I was their chief U.S. economist, and I've now been at Hossington for 22 years. So I've been in the game a long time.
A lot of the names that you just mentioned, that's very familiar with them. Didn't know them, but they were very big names. Especially, I graduated 50 years ago also, so we're at the same vintage here, Lacy. Lacy, I'd like to start, if we may, if you could take us through the key messages that you had in your latest Q4 report. And we have the link up on our site here for some of our listeners who may not have already read it or be familiar with it.
Well, I think our main view is that a huge buildup in debt, creation of a massive debt overhang, leads to economic decline. That's the main structural force. When debt levels are this high, they cut significantly into the trend rate of growth in economic activity. A number of very significant studies indicate that at high levels of debt that prevail not only in the United States but globally, economies tend to lose about 1/3 of their growth against trend. Historically, we've grown since 1790 about 2.1% per annum, which means we should have dropped down to about 1.4% rate of growth. But since 1990, when we moved into these high debt zones, our growth has dropped growth rate has dropped almost half. We're currently running at about 1.1% versus the 2.1 trend. And this is compounding a number of structural problems. We've produced a dramatic deterioration in our demographics. Population growth in the latest year is only 0.7%, which is well less than half of our long-term average. And by the way, that's the slowest growth in population since 1936 and 1937. We have a baby bust, a household formation bust. And there's a view that we can continue to rely on debt to pull us out. My view is that the buildup in debt is controlled by the law of diminishing returns. when you start increasing one of the factors of production, output initially rises rapidly, and then it diminishes. Eventually it turns flat, and then finally negative returns set in. And that becomes very worrisome when we understand that 10 years ago, global debt was around 276% of GDP, and it's now 51 percentage points higher, around 326%. So that's the main structural force. From a more cyclical point of view, the growth rate late last year was hailed, but my view is that the growth in the fourth quarter was artificially boosted by extreme natural disasters and the way in which disaster spending is accounted for in the national income and product accounts. When we have to replace cars, homes, businesses, personal possessions, business possessions as a result of a natural disaster, the National Bureau of Economic Analysis records that as spending, but they don't adjust for the capital loss. And so disaster spending actually serves to pull demand for cars, houses, and a host of other things from the future into the post-disaster recovery. But the economy is left saddled with those effects. Cars that would have been usable until, say, 2019, 2020, 2023, whatever, won't be replaced then because they were replaced earlier than scheduled. Additionally, the property and casualty companies had to pay out record claims. Unfortunately, after major disasters like this, the property and casualty companies raised their premiums. In fact, property and casualty premiums have risen very rapidly. And so that tends to act as a tax increase, like in situations where money supply and bank credit growth are now collapsing. And so the economy gets a boost from these things, but it actually makes the economy weaker. It's known as the fallacy of the broken glass. And so in the fourth quarter, when the GDP growth was around 2 3/4, just excluding the surge in automotive output, the growth rate was only 1.6%. And that doesn't also account for the fact that housing expenditures rose nearly as rapidly as automobile expenditures in the fourth quarter. And both of those sectors are now declining sharply from the fourth quarter to the first quarter. So the economy is in fact much more fundamentally weaker than is generally believed, but yet the Federal Reserve is continuing to tighten monetary policy very significantly. And while the whole world seems to be optimistic that the tax reductions are going to be a boost for economic activity, we have to keep in mind that this is a debt-financed tax cut. This is not a revenue-neutral tax cut. And so the net result is that basically the same folks that are getting the tax cut are paying the tax cut. And there's no net creation of new money. That's true even when we take into account the foreign sector as well. So so our view is that the economy is fundamentally weaker than most people believe. We believe that these cyclical and secular forces mean that we've still not seen the secular low and long-term interest rates and inflation. So that's a very quick summary of my view, much more complex than what I just told you, but that sort of captures it.
I think a lot of people, Lacy, have completely misunderstood on the tax cuts. You have to have fiscal cuts at the same time to make them work effectively. So a little bit of Pollyanna going on, and I agree too with the fourth quarter distortions very much so. And I think now we're seeing Q1 starting to be modified. Some of the GDP now Fed outlooks are starting to come down fairly dramatically, and I think you'll be proven right on that in the next couple of quarters. But
thank you so much. I greatly respect your view, and also keep in mind that there were clear signs of exhausted pent-up demand before the disasters hit there late in the third quarter.
Yes,
automobile sales were in a downtrend. They reversed partially in the fourth quarter. Now they've turned lower. There were signs of exhausted pent-up demand in apartment construction. Apartment construction had been the strongest component of the economy in this expansion. Now it's turning down. We're seeing apartment construction actually fall significantly below a year ago. There's also signs of exhausted pent-up demand in the single-family housing market and in capital spending as well. But I know the labor markets have been strong, but the orders or requisitions for personnel usually are placed are dependent upon growth of 3 or 4 months earlier. In other words, the requisitions for new personnel were made in the midst of the heaviest expenditures to try to get the Gulf Coast of the United States back in operation after those disasters. And so there is a labor market equivalent to the broken glass fallacy as well. And so, but on top of that, we're witnessing basically a collapse in both growth of M2 and in bank credit. Bank credit being bank loans and securities. And the yield curve is flattening very dramatically, as it has flattened prior to all of the recessions since 1942. So you have the whole constellation of monetary variables that are bearing restraint on the system. And the restraint is becoming evident not only in the shape of the yield curve, money and credit growth, the velocity of money, but it's also now becoming more evident in some of the sensitive rates that have major global implications. For example, the LIBOR OIS spreads have widened out. Those rates are now approaching 50% higher than the federal funds rate. That's an indication that the Fed's restraint on excess reserves of the banks is really biting. So we've had the Fed continue tightening against what is a fundamentally much weaker background than they or most people believe.
I'm with you very much, Lacy, on the increase, and it's concerning me, of the LIBOR OIS level we're at. We're back to just about the pre-crisis in Europe in 2012 kinds of levels, and the big concern is maybe not that so much as the hedging, FX currency hedging for the carry trade to buy U.S. Treasuries is really stopping it. The European money and Japanese money on the carry trade, it just doesn't make sense for them to be buying Treasuries right now on the yield if they have to hedge it, do currency hedge because of the weakness in the dollar. Are your views on that?
I'm largely with you there, but I would add this observation. I consider the foreign exchange markets to be the most forward-looking of all of our markets. I would say the long end of the Treasury market is probably the next most sensitive, then the commodities, and then the least sensitive are really the equity markets. Equity markets have not really been a very good leading indicator now for 30 years at turning points. So in the fourth quarter, and for all of last year, the foreign exchange markets were actually making a different statement than the stock markets. The U.S. economy was supposed to be roaring ahead, yet the dollar was falling. That continued somewhat into this year. But to my way of thinking, the foreign exchange markets, being partially influenced by the conditions you met. They're also forward-looking, and they've basically been seeing a future story of weakness in the U.S. Now, if I'm right on that, Gordon, and foreign exchange markets are very forward-looking, and they are also influenced by the pressure on overnight reserve availability, then once the weakness in the United States becomes clearer, the foreign exchange markets being forward-looking, at that point in time, we'll conclude that the next major move will be weakness around the world. The U.S. is still 27% of the global economy. And so once the U.S. weakness becomes more persistent and less open to doubt, then the dollar will rally. And at that point in time, it will then aggravate these other conditions.
Will that rally be somewhat of a flight to perceived safety?
Well, it'll be somewhat of a flight to quality, because what they will typically do once the weakness in the U.S. becomes clearer, they will conclude that the next signs of weakness will show up in Europe, Japan, and China. And so the weakness, once it becomes more consistent and apparent, the dollar will rally. Contrary of what's happened last year and early this year. And so if I'm right, the dollar is in a bottoming process because of the forward-looking nature of the foreign exchange markets.
Lacy, we're seeing, our work is showing, well, you mentioned earlier about the level of debt in the U.S. and demographics in your report. We're seeing, it's the same issue globally, that is global debt to global GDP is also at phenomenal levels, and they got the same demographics. And we're seeing pretty good indications of slowing global trade levels right now. And so it reflects here into the U.S. Where do you see us in the current business cycle, economic cycle? We're a long time into this recovery.
Well, expansions don't die by old age, but one of the elements that's not really seen in a long-lasting expansion is exhaustion of pent-up demand. Pent-up demand is a critical concept in economics. You don't get monthly reports on pent-up demand. But as expansions move along, you replace your cars, your houses, your businesses, and so the underlying physical need for things diminishes. And let's just look around the world. We've got a glut of retail space, which is getting worse. And although retail construction has slowed down the last couple of years, we had a massive surge in retail construction for most of this expansion, started in 2009. We had the fastest growing component of this whole expansion, this long-running expansion, was multifamily apartment construction. And now we've built so many units that rents are basically falling nationally. There's some discrepancies depending upon regional demographics, but the retail rents are falling. The apartment the apartment rents are falling, and the same can be said for office construction. And so, long-running expansions through the vehicle of pent-up demand basically undermine their viability. But we also have to think very, very critically about this tax cut. This is a debt finance tax. The original idea was that the Affordable Care Act was going to be reformed. It's running deficits that are quite large, kind of hard to know exactly, but they're at least $200 billion. They may be rising toward $300 billion very quickly. If the Affordable Care Act could have been reformed to the tune of $200 billion, then you could have had a tax cut of $200 billion, which would not have enlarged the deficit. And at least in that sense, the economy would have gotten a boost, because tax multipliers are more powerful than expenditure multipliers. And there's also some evidence when you have a revenue neutral tax cut, you lower the long-term cost of capital, you raise productivity in general. But in this particular case, this is a strictly debt financed tax cut. And in that situation, the problem is that the Federal Reserve is not helping to fund the debt. In fact, what are they doing? They sold $30 billion of securities in the fourth quarter. They're selling $60 billion this quarter, well on their way. Then they're going to sell $90 billion in the second quarter. Well, between this quarter and next quarter, the Fed is removing $150 billion from their portfolio, which is identical to the tax cut. The BEA figures have a $115 billion individual tax cut and a $35 billion corporate tax cut. But then the Fed is going to sell on according to their schedule, which I don't believe will actually be achieved, $120 billion of securities in the third quarter and $150 billion in the fourth quarter. So the Fed is not buying, and in fact, they're selling, which is really adding to the supply of debt. Gordon, I don't know whether you look at the bank credit figures weekly, monthly, but they're very, very interesting. In February, total bank credit of all banks actually declined at a 1.6% annual rate. In order to fund just a very small increase in loans, much slower rate of increase than what we've seen in this expansion, dramatically slower, the banks had to liquidate securities. This is the part and parcel of this whole process of intensifying pressure on the reserve. The banks do not have enough reserves to maintain their balance sheet. They prefer loans to securities, so they're liquidating securities. And it's also the reason why the LIBOR OIS spreads are widening out.
Lacy, we just did a fair bit of work looking at most of the major international banks, and we were stunned to see that over the last couple of years, their assets on their asset side has been steadily falling. All the major banks, not increasing, not growing, but shrinking.
Well, that's interesting. I just look at the U.S. banks.
Well, there's definitely in the U.S., but we saw it globally with all of them, right from
interesting
the major players.
I'd like you to send me your work. I'd like to read what you wrote about it.
Glad to.
So the Fed's not buying. The banks are not buying. That means we've got to then fund the debt by what's called the non-bank sector, the private non-bank sector. Now, some may say, well, doesn't that also include the foreign purchasers? But the foreign sector, the only additional funds they receive is by running a larger current account surplus against us. And folks really don't understand one of the most critical points in macroeconomics. When a country runs a current account deficit, which is currently 2% of GDP, then we have a capital surplus of 2% of GDP. The net foreign saving is the actual inverse of the current account deficit. So let's say, just for hypothetical reasons, that the Shalers have a good year and they help us reduce the current account deficit from 2% of GDP to 1% of GDP, or make it less negative by 1%. Well, that means net foreign investment, which is currently 2% of GDP, goes to 1%, which means then that us folks, you, me, what's known as the private, non-foreign, non-bank sector, we have to fund more of the deficit. In other words, all that's happening in here is either the Treasury is going to collect the funds directly from us folks, you and me and our businesses, or they're going to get some assist from the foreign sector, depending upon what happens to the condition of the current account. But the current account deficit still comes from you and me. What it boils down to is that the private, domestic, non-bank sector has to fund the current account deficit and the budget deficit. So if for some reason our trade deficit, our current account deficit becomes less negative, then the private, non-bank, domestic sector will fund more of the tax cut directly. If the shalers are successful and we reduce the current account deficit, then the foreigners will fund an increasing amount of the deficit. But those funds come from the private, domestic, non-bank sector. In other words, regardless of how you look at it, us folks, Gordon, are going to fund the tax cut. But there's one other rub. The Treasury is going to be issuing debt at a 7.5-year maturity. And that's going to make the economy less liquid, which means that the Treasury's actions in this environment are going to further flatten the yield curve and perhaps move it closer to inversion. Well, the flattening of the yield curve at a time when bank credit is no longer growing, that puts banks in an increasingly weaker profitable situation.
You'd mentioned the last time we talked that we didn't necessarily have to see an inversion in the yield curve to take us into a recession because of the amount of debt, but you're suggesting there's a strong possibility it will invert.
That's correct. I did say that. And
if you look at... That's changed since we last talked, too, by the way.
If you look at the spread between the 3-month bill and the long bond, the 20 to 30 year, you can calculate that spread actually for 75 years, going back to 1942. Now, other spots of the yield curve can be analyzed, but they're only for shorter periods of time. And for me, it seems best to look as much data as possible. And using the 3-month to the long bond, the yield curve has flattened prior to all the recessions since 42, no exception. In the last 7 recessions, the yield curve actually inverted slightly. Now, but the yield spread is like the money supply or bank credit or the velocity of money. It's one of the channels of monetary policy influence on economic activity. One has to look at the total constellation of conditions. And so in the present environment, M2 growth, Gordon, last year was in the 4th quintile. In other words, for the year 2017 was in the lowest, the 2nd lowest quintile. But M2 growth now is moving into the lowest, or the 5th quintile. Extremely weak. I mean, historically, when M2 growth has fallen into the 4th and 5th quintiles, bad things generally happen. Good things and inflation happen when you're in the 1st quintile. In other words, this is no longer a run-of-the-mill monetary growth environment. Same is true for bank credit. In fact, you might take a look at this, and your listeners might take a look at it. You can take the spread between the rate of growth in bank credit yearly, on a 12-month basis, and subtract out the rate of growth in nominal GDP, and what you'll see that bank credit now is growing significantly below the rate of growth in nominal GDP, and when that happens, it's another negative leading indicator, very important leading indicator. And so far this year, bank credit growth is basically zero, might be up 0.1% or something, and GDP is much higher, which is not a sustainable situation going forward. So we could easily invert, as we have done in prior to six of the last recessions. But the other initial conditions are negative: money supply, bank credit. The velocity of money is in its fifth quintile. It's very weak. There was a gain in the fourth quarter in velocity, but that was a one-off event tied to the fallacy of the broken glass. And and we also have a highly indebted economy. So it's in looking at the thrust of monetary policy, never rely on one single indicator. Try to look at all of the channels of monetary influence on economic activity. And what we have right now, they're all saying the same thing. They're all telling the same story, Gordon.
Yeah, I'm with you on that, and agree with your observation. Lacy, I said earlier that a lot's changed since we last talked, and that was in December. And we talked about, since then, the tax bill and the ramifications of it. But, we've got a budget. We've got talks about infrastructure spending and what's going to come into it. The increase in really getting rid of the budget caps and the amount of money that's going through. When I look at supply, there's a tremendous amount of supply that we can expect, and especially if normalization continues. Your views on the level of that?
Well, absolutely. I mean, the federal budget deficit is going to implode, and the Treasury's fiscal situation is actually much worse than the overall deficit. In the prior 3 fiscal years, the cumulative budget deficit was around $1.2 trillion. But because so many things have been thrown off budget, the total increase in federal debt was actually in excess of $3 trillion, almost double. But what determines the best theory, not only based on intellectual grounds, but also by empirical evidence of interest rates, is the one that was developed by Professor Friedman. And what Friedman said, and this confounds a lot of people, is that monetary accelerations lead to higher interest rates. Monetary decelerations lead to lower interest rates. Here's what Friedman had in mind. When the Fed accelerates monetary growth, that short-term effect is what's known as the liquidity effect. They pump more reserves and money into the system, and it temporarily lowers the short-term rates, boosts economic activity. If the liquidity effect is continued, eventually, however, it will cause what Friedman termed an income effect or output effect. And as the monetary stimulus seeks into the system, then interest rates reverse the liquidity effect and start to move higher. And if the persistence in accelerating monetary growth is still intact, then you eventually lead to the price effect. But Friedman also said that monetary decelerations lead to lower interest rates. Now, the Fed is in a monetary deceleration right now. They're lowering the rate of growth in money and bank credit. But monetary decelerations raise the short rates, no question about that. But when you persist with a monetary deceleration, keep in mind that the monetary deceleration has now been going on for about 2 years, slightly more than 2 years. So at some point, you get an income effect. The economy begins to fade, output begins to fade, and that starts to reverse the liquidity effect, just as the process works in reverse when there's a monetary acceleration. And then eventually you get a price effect. And so the budget deficit in the current environment, with the Fed tightening monetary conditions, will serve to accentuate the flattening of the curve. Well, the banks make a profit by borrowing short and lending long. That spread's coming in dramatically, makes them less profitable. But it also undermines the profitability of all of those that are acting like banks, because the way they make a profit is by borrowing short and lending long. And today, in today's environment, if you're a non-bank lender and you're thinly capitalized, you more or less have to hedge your interest risk. But when you do that, there's no spread left. And so the monetary tightening is moving into a more advanced stage. But the critical thing to understand is the soundness of Friedman's theory of interest rates. And that is that monetary deceleration, slowdown in money and bank credit growth, flattening in the yield curve, ultimately lead to lower interest rates, not higher interest rates. There can be pressure over the short term, but not in the long run.
Lacy, comments on the rhetoric we have, and they're not rhetoric, it's actions we're seeing regarding, I'll call it fair trade, but free trade, protectionism, tariffs, some of the things going on specifically even with NAFTA. What concerns you have there?
Well, here's the thing you have to remember, and I just said this earlier, but let's just go through it. It's a complicated concept. The capital account is the exact inverse of the current account in the balance of payments. They have to balance. So if you have, as we do now, a current account deficit in real dollars of 2% of GDP, the capital account is minus 1 times the current account deficit. So in that case, the capital account is in surplus of 2% of GDP. Okay, so let's say that we impose tariffs or do other things to restrain imports of U.S. goods. Well, and they are successful initially, and they would only be successful for a very limited period of time. In that same instance, when you're reducing the current account deficit, you're also reducing the capital account surplus, what we call net foreign saving. In other words, you restrict the foreign capital that is being reinvested in the United States, and the private non-bank sector then has to fund more of the deficit, and at a 7.5-year maturity. But the rest of the world will not be able to tolerate that, because their capital account surplus will go down. I mean, their current account surplus will go down, and their capital deficit will increase. And so once the retaliation occurs, that starts a process known as the race to the bottom. It reduces economic growth and capital flows simultaneously in the country that is taking the adverse or the unilateral actions against trade. And when there is retaliation, it repeats the process overseas. Let me give you the great example. In 1925, France returned to the gold standard. They were the most devastated country by World War I. They had depreciated the franc by about 25% during World War I. But in 1925, when they went back on the gold standard, they depreciated the franc by another 40%. The world tolerated it. They didn't like it, but they tolerated it because France had borne the brunt of World War II. But by 1927, there were weak players in the global system. Particularly, it started with the Dutch East Indies, now we call it Indonesia. They devalued. Then Australia devalued. By 1931, 17 or 18 other countries were devaluing. And in 1931, the British finally devalued. In other words, people only gained a trend, and this was forcing global trade lower, capital flows lower, causing the race to the bottom. And then finally, in in 1933, from April of 33 to December of 33, the U.S. devalued by about 60%, which was equivalent to most of the devaluations that had preceded in the rest of the world after the French devaluation of 25. And so you perpetuated the economic weakness. And by the way, when we devalued in 1933, very shortly, China, which was on a bimetallic standard, they devalued, perpetuating this trade war, race to the bottom. And then Italy, under Benito Mussolini, devalued by 60.1%. They went a tenth more than our devaluation. That eventually caused all France and all of the gold black countries to devalue after that. And they had started the process in 25, making continuations around the globe perpetually worse. Unfortunately, it was broken when Germany invaded Poland in 1939. But this process is of unilateral trade actions is very harmful to the country that initiates the process, and then to the rest of the world. And then the repercussions are sent back to the original actor through the weaker global economic activity and the diminution of world trade and capital flows simultaneously. This is not a process you want to do, Gordon. Not at all. And by the way, it's deflationary.
Yes.
Initially, it's inflationary, but because of the declines in trade and economic growth and well-being, everybody is made worse off simultaneously.
Of all the things out there that are troubling, and there are a lot of them, this is a road that worries me, and I'm already seeing retaliatory threats from, I was just reading about what Brazil was doing. EU is talking about, I just give an example, Harley-Davidson restriction of motorcycle. That couldn't be enough to put a Harley-Davidson's right on the border right now under. It just goes on. So it's not wise, but I would say that the greater problem, and one that's not well understood, is that continuing to rely on debt, the debt factor of production, is going to trigger the law of diminishing returns, one of the most important concepts in economics. And so the end game of trying to use debt to solve our economic problems ultimately is going to produce even worse results. And you're already beginning to see proposals that at the start of the next downturn, there will be massive increases in debt, trying to fund it somehow by the Treasury, have the Federal Reserve fund it. But that does not negate the fact that debt capital is a factor of production, and its overuse will result in declining marginal productivity of debt and stagnation in economic activity. And Gordon, that's more of a problem. They're both nasty problems, but we cannot continue along the high debt path, and we can certainly not exacerbate it by engaging in trade wars. I'm with you on that, and clearly, Lacy, we have.
But Gordon, you know, this should be understandable, but it's not.
It's not.
and I will tell you that there's a view that the economy should be simpler than that, but it's not simpler than that. The economy is complex, and one has to take into account the first round, the second round, and the later rounds. And that's why Professor Friedman's theory of interest rate is so useful. It takes into account the first round, the liquidity effect, the income effect, and ultimately the price effect. And that's why monetary decelerations lead eventually to lower interest rates, not higher interest rates. And taking into account first, second, and later rounds is why diminution of world trade leads to declining standards of living and deflation, not to economic prosperity. There may be some individual winners and losers, as there would be from a debt finance tax cut. Yes, there will be some definite individual winners and losers, But in aggregate, the private non-bank sector will not benefit. The private non-bank sector will not benefit from higher tariffs.
Lacy, we have to break. Unfortunately, I always enjoy these conversations, but we're out of time.
I enjoy your questions, Gordon.
Well, I have one more for you that I have to ask, and I know our listeners will ask me. Do you see an upper bound here on the 10-year Treasury before we head lower on yield?
I'm never very good for the short run. I think over the short run, there's so many extraneous factors that influence the longer term rates. I'm not really much of an expert in the 10-year. My expertise is in the 20 to 30-year range, but there are too many extraneous elements, idiosyncratic factors that influence the long-term Treasury rates over the short run. And they're basically not predictable, or at least they're not predictable by me.
Mm-hmm.
But this is my position. The long-term rates can go up, Gordon, but the economy is too fundamentally weak for them to stay up.
This time next year, 12 months or 18 months from now, we can expect the longer-term yields to be lower than they are today for all these reasons.
I believe that, and believe so strongly, Gordon.
Yeah, and we're with you on that too. We're just amazed.
Well, I appreciate that, and I appreciate you sharing your thoughts.
Well, I was surprised taking this long, and you're right on the short term. We think there's a little bit more lift here in yield, but when it comes down, these happen very quickly when they do finally.
Yeah, well, you have to be ready. It's better to take the long view. It will be a crowded trade.
Yeah, well, right now the shorts on the bond market are so busy. There could be a squeeze here, but that's for the traders. We're not traders here, so we look at the long.
And remember what my work shows, that the most forward-looking of the markets are the currency markets. And when the foreign currency markets are convinced that the U.S. economy is weakening, the dollar will rally. And shortly after that, you'll see the bonds improve considerably. It's kind of counterintuitive thinking, but that's the way the world works. The foreign exchange markets are very forward-looking, and they'll point the way.
We agree too. Whether we look at them kind of between the credit market being the first or the currency markets, but the signals are there. And when it finally gets to the equity markets, it's like the tail on the end of the dog.
Well said, Gordon.
Because you can see
well
it.
Said.
You can see the breaks, and we're watching.
Oh, absolutely.
The high yield market.
So if the dollar is trying to make a bottom now, which I believe that it is, that's an important sign. And the dollar, the turn in the dollar is the fact that the economic numbers are falling short. Not all of them. They're intermittent still signs, because all the economy does not move together. But they are beginning to show a weaker trend in general. And we have the slowdown in a collapse in money supply growth, bank credit growth, flattening in the yield curve, and a very low velocity of money. And these are powerful and consequential forces. And when they're looked at in their totality, the underpinnings, the pylons supporting the overall economy are eroding. And that's the more significant thing for a long-term investor, which is what I consider myself to be.
Have to break, Lacy. We'll definitely be talking again. Any final comments you'd like to make?
No, but we do make our quarterly letter available as a public service. We've had so many requests in recent years that the way we make it a public service is by putting on our website. And we're no longer in a position to email them out, but our quarterly letters will be posted on our website about, say, 10 business days after the end of the quarter. But it will be available as a public service on the website.
Well, we'll be posting your latest, which is the Q4 one, and your website address is?
It's HoisingtonMGT.com.
And we'll have,
HoisingtonMGT.com.
again, thank you for your being so gracious with your time, Lacy. Much appreciated. We'll
Always a pleasure, Gordon. Always a pleasure to talk to you.
Well, maybe next time we'll be able to do a video.
Okay, let's go for it.
So our listeners can see some of our expressions and some of how strongly we feel about this if it wasn't coming through in our voices. Talk to you again.
Okay, Gordon. All the best to you.
Bye-bye.
The FRA Roundtable Insight Show is for informational and educational purposes only and should not be considered as a solicitation or offer to purchase or sell any securities. The investments, investment strategies, and investment philosophies discussed or presented on the show each involve their own unique risk factors which are not discussed on the show. Any discussions among the panel participants or responses to listener inquiries are based on the personal opinions of the panel participants and do not take into consideration the listener's suitability, objectives, or risk tolerance. Please be advised that you invest or speculate at your own risk.